Hello, everyone, and welcome to Edison Group Investment Funds Forum. My name is Victoria Chernik. I'm an investment director at Edison Investment Funds team. Today's topic is investing in blue chip companies, global blue chip companies for income and growth. This forum is designed to be thought-provoking, but it is not in itself an investment advice. We have two guests with us today discussing the topic. Chris Parry is an independent strategy consultant. Chris spent 35 years with Royal Navy advising the organization about strategy and strategic matters. Nowadays, Chris runs his own strategic forecasting company, advising governments, commercial companies, and also banks on strategy, leadership, and systemic risks. He's also an author and lecturer and forecasts future trends in geopolitics and expectations and risks. As a matter of fact, Chris got both the recent US and UK elections results right. James Harries is our another guest. He's a fund manager at Troy Asset Management. It's been there since 2016. James is a global equity income fund manager, and prior to Troy, he spent over 25 years at Newton Asset Management, running global equities income strategies, and earned a very strong track record doing that. James took over management of Securities Trust of Scotland last year when Troy won the mandate to run the fund. Gentlemen, welcome.
Thanks very much.
Chris, perhaps we can start with you. If you could give us, where is the world today? You could give us the geopolitical, social, and perhaps a bit of an economic backdrop, given the unusual year of 2020 we've just been through.
Well, thank you, Victoria, and hello, everybody. I think everybody's been living geopolitics for some time now, because quite a lot of the trends that existed before the COVID epidemic have been essentially amplified and accelerated by the progress of the virus. And I think what has emerged is a connected but also a contested world. And we've seen essentially the rise of a two-block structure. It's not really a Cold War, as some people are saying it, but it is definitely settling down into a two-block world, and that is ideological, geopolitical, and also economic. And what we're seeing is what I term a Eurasian authoritarian bloc, which consists at the moment of the regimes associated with China, Russia, and Iran. And we're seeing a maritime democratic bloc emerging: United States, Canada, parts of Europe, certainly the UK, Australia, New Zealand, Japan, South Korea, and also India. And what we're seeing very much now is other countries aligning for economic or indeed geopolitical reasons with one or other of those two blocks. Some countries, of course, are trying to sit on the fence, but this is rapidly becoming a world where people are going to have to declare their political allegiance and their economic dependencies in relation to one or other of those two blocks. Some countries obviously try to straddle the divide. Germany, for example, is heavily invested in Nord Stream 2. Italy is invested in the Belt and Road Initiative. A number of countries are host to Chinese investments in their port and infrastructure, particularly along the Belt and Road. And what we're seeing, as I said, is a hardening of these two blocks. And much of the geopolitical activity and the economic risks will lie, if you like, in the rubbing of those tectonic blocks together. And there'll be seismic seismic sort of movements, which we will have to forecast and also mitigate as we go forward. And to give you one example, we're already seeing that China, in response to any geopolitical opposition, is imposing economic sanctions, tariffs, and informational pressure on those individuals, corporations, and countries that defy it. We're used to the United States and the free world imposing sanctions for geopolitical infractions. What we're not used to is seeing it come back from the other way, from Russia, from China, and increasingly now Iran. And so laid on top of the financial and economic framework, we've now got a geopolitical, very dynamic geopolitical arrangement that will affect every decision that is made about investments, particularly blue chip, where you want your risk to lie and where you think those long-term investments will do you the most good and give you the most return. And I think that's probably enough for an introduction, Victoria.
Fascinating, Chris. Thank you, James. So, what does it all mean for the where we are in the investment world right now? Again, given the events of 2020, and we're kind of on the crossroads, returning back to normality. What's your view on the investment environment right now?
It's obviously a huge question, and Chris has set it up in a very sort of large way, but it is interesting that what we're talking about here is structural trends and the structural backdrop. And echoing what Chris was saying, it's been a phenomenally benign time to be an investor for the last 20 or 30 years, not just from a geopolitical perspective. We've had the Pax Americanus and so on the war, and it's been an amazingly sort of it may not feel like it, but you haven't really had to worry about very much for quite a long period of time. What I mean by that is you haven't had this particular conflict that Chris talks about. You've also had a number of other factors that have been very much in your favor. So if you go back 30 years or so, you had a far more favorable demographic backdrop. People were much younger and therefore about to embark upon consumption and activity and buying a house and all of that, which has been a tremendous boost to the economy. You have much lower levels of debt. So people were able to take on debt to augment their consumption and generally, therefore, augment consumption activity. You had extending globalization, which is ultimately a positive shift in the supply curve, i.e. you had more and more people coming into the global workforce, which put downward pressure on wages and upward pressure on productivity. And you had amazingly good valuations. If you go back to the beginning of the 80s, after the 70s, it was a phenomenal time to be investing. Didn't feel like it because you just had the oil shock and the winter business in this country and so on and so forth. But actually, valuations were amazingly inexpensive. The S&P was about 8 times earnings, 7.5 times earnings. Today, none of that is the case. So, of course, we have much higher levels of debt. We have much less favorable demographics. The world population is aging. Globalization, as we've heard from Chris and will no doubt continue to hear, is paused, if not begun to reverse. It's unlikely to be as much of a tailwind in the future as it's been in the past. And valuations are far less attractive, but across capital markets, equities, credit, government debt, and so on. And then we have COVID, right at the time when these things are beginning to become less of a tailwind. What's so interesting about COVID is that it's represented really a slowdown and an acceleration all at the same time. So it's been a slowdown in the global economy, but it's been an acceleration in existing trends in terms of the penetration of technology, in terms of the way we use technologies, and in terms of some industries finding themselves to be severely disrupted. So to then add a geopolitical factor onto whatever, to my mind, is already quite a difficult backdrop in the sense that we've got pretty elevated valuations and a pretty uncertain economic outlook, is something that I think will need to be considered, but I'll be very interested to see what Chris has to say.
So, but I mean, James, you managed the portfolio for many years, I mean, since 2005, and you explained how you've seen the dynamics of various factors changing. So, how is it affecting your portfolio, your decisions, the companies that you invest in? Do you see these structural changes coming in that you will be avoiding some companies or maybe some regions? Chris mentioned China and Russia and Eastern Bloc. Is it something that is affecting your decisions now more than before? Well,
as I mentioned, as a global investor, you haven't really had to worry about any of this stuff for a long time. And the way we tend to deal with it, generally speaking, just to step back for a second, our process is to try and produce better than average returns with below average volatility, to view risk in sort of absolute terms, and not invest with reference to a benchmark. So we don't need to invest anywhere. We don't spend too much time thinking about how we're positioned relative to others. Further, we seek to invest in particular sectors and businesses which we think have high returns on capital employed, resiliency, durability, pricing power, and so on. So that leads us to areas like consumer staples, towards healthcare, to technology, and away from the more capital and cyclical areas of the global economy, such as mining, such as oil, such as bulk chemical companies. And so I think if the situation is becoming a bit more difficult and if valuations are less favorable, I think a process like ours, I would say this, wouldn't I, but should be relatively robust in that sort of environment. And I guess the final point to make on that, just in the very short term, there's just been rather big rotation in equity markets away from the sorts of things we favor towards the things that we don't. And so that's actually a bit of an opportunity for us to buy more of the things that we do like. So we've always been very selective about the sorts of businesses in which we invest, and we will certainly continue to be so. As regards your question with regard to emerging markets, the ex-Unilever CEO, Paul Polman, said, you got to invest in emerging markets because that's where all the people are. And I know that's a very simple thing to say, but it's actually true at some level. And so therefore, if you do invest in large global businesses as we do, you will always have some exposure to emerging markets. I think on an underlying revenue basis in our portfolio, our emerging market exposure at the moment is in the order of 14%, something of that order.
Okay. Yeah.
And over time, the exposure will increase, I suspect, because our management teams will be allocating capital to the emerging markets. But of course, that's on an underlying basis rather than directly. But the reality of the fact that there are very large and hopefully over time more prosperous populations should mean that it still remains fertile ground, notwithstanding the sort of considerations that Chris is going to be talking about.
I think what's interesting there, James, is there's going to be a scramble, a competition for the emerging markets, because we know that China is still very much dependent on investment flows from what I would call the free world. It also needs technology and some of the expertise as well. But I foresee very soon now that China itself will be competing for those emerging markets in competition, particularly with the free world investment flows. And we're seeing with the duplication of financial organizations, all these Asian development banks and this, that, and the other in competition to the IMF and the World Bank, possibility of a new SWIFT system to displace the dollar as the unit of currency for which settlements are made. And I think we can see that all that area between those two blocks will be a vast competitive field, not just geopolitically, but in terms of investment in order to get return and rents and all that sort of thing that we associate with mature capitalist systems. So I think this is the real Wild West, the new great game, if you like. And we've got to separate out China, for example, from the rest of the emerging markets and recognize that there is significant risk in China, and you're going to have to really calibrate. And I think you also need to see how far you are exposed in China in relation to what China itself says. I mean, only today I've heard a government minister in China say, look, if you're making money here in China, you've got to accept our terms and conditions. So we don't want companies, making money in China who criticize our geopolitical approach to, for example, Xinjiang or Hong Kong or Taiwan. And so this introduces serious pressures into investment flows, because what are you risking? You're risking the party in China, for example, closing you down instantly.
And absolutely, and China is intriguing, and I agree it probably should be split out to a degree, because of course it is a very different system, and to lump all emerging markets into one probably doesn't make a great deal of sense. I mean, I was talking, coincidentally, we were talking to the chairman of Unilever this morning, and Unilever is a business that's been doing huge amounts of business in areas like Indonesia and India for years and years and years, and will continue to do so, and will do very nicely, thank you. But China is a bit different, and the conundrum of China is really that the prize is so big, that size economy opening up for the first time in a long time, and being able to, that whole thing about if I can just sell one, whatever, to every person in China, wouldn't that be amazing? And that's true. But you also do have this very different regime, this very different situation in which to operate. So I looked at this before this call, and our underlying revenue exposure to China is currently about 4%. But there are a number of businesses we either own or we'd like to own, whose long-term profitability and prospects are likely to be driven probably in large part, if not in some part, by their successful failure in China. So Starbucks would be a good example of that, or LVMH would be another good example of that, or Intercontinental Hotels Group. So for many businesses, it's too big and too attractive to ignore. But generally speaking, we would like to be investing in businesses that are allocating capital there on our behalf, and are trying to do it in a sensible way, but also to ensure that we don't have just too much exposure there. So it is a fascinating economy.
James, on that, you mentioned the expression opening up. I would postulate actually that the opposite action is in play at the moment, it's closing down. Because I think there is a desire in China to sinicize, to take over as much business as it can, as soon as it can. And the opening up is possibly only a short-term thing, and the contraction will occur at some stage when the party decides that it wants to generate its own internal wealth and returns at the expense of those who, I quote Xi Jinping on this, who sucked on the teat for far too long.
Well, and as a signing file, you'll know the history, which is the economy opens up and then money piles in, and then they tend to shut down and the money gets lost. And there is a possibility that will happen here again. And you're absolutely right that, we saw this morning H&M had negative news.
Yes.
And Burberry had negative news because they are not playing ball, if you like, with regards to where they're sourcing cotton from as a result of their concerns relating to the treatment of Muslim minorities. So these sort of things are bubbling up, and they do, and they will. So I'm not really disagreeing with you. I'm just saying that there have been great opportunities. Companies have sought to exploit them. Perhaps they'll be less attractive in the future than in the past. And I don't think it's any news that China is seeking to learn, is seeking to move its way up the value chain and up the intellectual capital chain, and to have as much of that onshore and domestic as possible. That isn't new. But at the same time, they do have this other overriding concern that they've got an awful lot of people who have had a taste of some prosperity, and they can't just take it away. So there are other dynamics at play here, I would suggest.
Actually, James, I wanted to throw out a question to you with regards to the global investing and China in particular. I mean, it is a fairly small part of global indices as an investment universe. It is you mentioned your exposure, direct exposure of your portfolio by revenue and to the region. Do you think that, given what Chris is saying and all the risks, the exposure of global funds and yours as well, and what do you think, the overall global universe is going to be larger to China and less large to the United States, to the US quota stocks, which is now over half of the universe anyway?
Yes, on that topic, to begin with, the vast majority of our portfolios are invested in, the largest country in which we're invested by far is the US. We find it to be the most attractive economy. We find it to be to have the best companies. They have this amazing equity culture where they're able to innovate and then exploit innovation at scale via equity investment. And this is something that I was listening to a podcast with the CEO of London Stock Exchange, oddly enough, recently, who made a very, very strong case for how America is so powerful in this regard and how other parts of the world really don't have this culture to the same degree. What a differentiator it is. And when you go to the States, you travel around the States, it's just, it stops you being too cautious because there's just so much going on. So we will always have a large part of our capital allocated to the US. But at the same time, the economic heft is slowly shifting eastwards, or at least has been. And that, I think, is to a degree inevitable to reflect the economic heft which is in that part of the world relative to the States. I mean, one doesn't want to overplay it, and you can read 100 books about how the dollar is going to go into structural decline and everything's going to be run by China. I don't buy that at all. I've never bought that. But I do think that there is going to be a shift in terms of capital flows and influence, probably eastwards, which will over time be reflected in capital markets. It's already been reflected in the bond market, where Chinese domestic government bonds are in the indices now, and I suspect the same dynamic over time will probably play out in equity indices. We'll see.
Yeah, fascinating. So, Chris, do you think it's going to be managed well or smoothly, relatively, politically wise and regulations wise?
Well, I think the real issue is the friction that will be induced by this geopolitical competition. It's going to wash over into financial and economic markets. There's no question about that. I mean, I think where we will see return and where we will see risk manifesting themselves in equal measure, but also very dynamically, is in where these various countries position themselves relative to China and the United States. For example, let's have a look at Malaysia, Indonesia, even Vietnam. Which side of the geopolitical divide are they going to choose to actually position themselves at a time when China's seeking to build up a huge Asia Pacific, what I call a trade and tribute hub? To what extent will those countries say, well, actually, we don't want to be embraced by China. We'd like to move closer to what the free world bloc is doing. So you're going to have this very ragged dynamic edge, very unstable edge, I would suggest. And that gives you both risk and opportunity. What will complicate that further is a tendency, I think, to go for diversity of sourcing of raw materials, manufacturers, supply chains will become more diverse as a result of what we've seen happening with monopoly suppliers feeding monopoly receivers during COVID. It's made the system very fragile and unstable, and people are, and I think the just enough, just in time model is going to have to be extended to make sure there is some flex in the system in case of future disruptions, either because of geopolitical activity or perhaps a return of another virus or something like that. I think people have got now that Mother Nature still has a vote in relation to what happens on this planet. And I think people will seek to be within their firms, within their supply chains, within their investments, much more resilient and less fragile. Whilst acknowledging that risk can be taken when it's calibrated, just as James says happens in the States. But I think there's this additional dimension now saying what is going on in the world. We have to be aware that every regime in the world, whether it's authoritarian or democratic, is looking for legitimacy. And where you find the rule of law is strong, your investments are going to be safe. Where it's less strong, you'll see the rule of law manipulated in support of the legitimacy of regimes wherever they are. And that needs to be taken into account. And I think some of that has been sort of shown by what's happened with the EU over vaccines. The law has been a very flexible instrument when it comes to geopolitical outcomes and the legitimacy of political regimes and politicians. So my word always now is to all boards of financial institutions, you must have a weather eye to the increased dynamic of the geopolitical environment. And I think James and I have discussed this throughout this sort of presentation, that is the case. We've hinted at it, but it really is the case.
Yes, I see. Probably like a continuation of this theme. Probably we'll start with James. Do you think that companies are going to become blue chip companies more conservative in terms of paying out dividends, dividend payout ratios? Sort of where are we now? Where do you see the situation going, given that last year so many companies postponed dividends or somehow kind of cut them?
Well, I'm pleased to say we were able to grow our dividend last year in our fund by 4.9% year on year. That's in the open-ended fund. Of course, we haven't been running Securities Trust of Scotland long enough to demonstrate that resiliency. But part of the way we go about selecting businesses at Troy is for them to be resilient, for them to have a diversity of product type, diversity of route to market, diversity of end market, in order to provide a degree of resiliency and predictability. That isn't always the case, obviously, but generally speaking, is the case and is an attractive thing to find. So, and furthermore, on a global basis, we've seen a lot of dividend. Just to be parochial for a moment, we've been seeing a lot of dividend cuts in the UK. Part of that is because many UK companies were over distributing, frankly. They were paying out too much to their shareholders, neglecting the core business, neglecting investing in their competitive advantages. Now, that isn't the case globally. If you look at globally, companies have been more conservative in the way they pay out dividends. And so they can continue to do so, and the average payout ratio is lower. Now, where we try and square the circle, when I say that we invest in businesses that don't require a lot of capital to run themselves, that matters. Because if you invest in capital-light businesses, they both have money to be able to entrench their competitive advantage and be able to pay a dividend. And that really is the ideal scenario. It also means, by the way, that you don't have big bits of capital equipment stuck in some locality that might become more problematic politically in future. They tend to be capital light, often equals asset light too. So we are, I sort of went back earlier, you know, one of the ironies is at the moment that we have, the consensus appears to be that we're at the beginning of a new cycle, that we've come out of the COVID low and that we're embarking on a new bull market and a new economic cycle. To me, that seems somewhat surprising or fanciful, given that we have equity markets and bond markets that much, and particularly equity markets trading at near all-time highs. Very few times in history where markets have traded at these levels in terms of valuation. And to suggest that therefore we can kick on to a new cycle and a new bull market seems to be somewhat optimistic. Ironically enough, because of the recent rotation, we're actually finding some very good, resilient, you know, businesses that might not be the fastest growing and might not be currently performing, but actually have a great degree of resiliency and dependability, and they've been left by the wayside by some investors. So we're actually finding a lot of businesses in which to invest at the moment.
That's really good. Yes, I think we kind of to finalize our discussion. I mean, just a few words. Your outlook for this year, Chris. I mean, what's your take on 2021 in like 3 bullet points, and then I'll turn to James.
Well, I think 2021 will be easing ourselves out of COVID and the downstream actions of that. Obviously, I think there will be an initial boom. There's a lot of money stored up in personal and institutional accounts right now. People are not investing in the way they have in the past because they want to see how the future turns out. I think the biggest issue, in my view, that people aren't seeing at the moment is how you manage the vast amounts of debt that is out there, both government and institutional debt. We're not used to managing a debt-based economy, global or otherwise, and how those debts are managed, how they are valued, I think is incredibly important. And I would point people to the 1930s, the last time we really had debt on this scale across the globe and within countries. And I think along with growth, which obviously will be important, I think will happen, we have to look out for the shocks that will be induced by that debt, particularly the deficits and debts that are owned by governments, and who actually owns that debt in the wider world.
Thank you. Thank you. James, what's your take on 2021?
I think that's right. I think that the explosion in levels of indebtedness has been largely ignored. I mean, I said that again, going back to what I was saying before, that the consensus narrative is that COVID represented a major low in markets. If I could just draw a distinction between the economy and markets, a major low in markets, and then as we recover, then we'll go into a new bull market. I wonder if actually, because the market always does the opposite of what everyone expects, rather than COVID driving a market low, COVID provided the political cover to policy settings that will drive a market high. We don't know, but it feels awfully like it to me. Yeah. So therefore, I do actually feel prevailing valuations mean that one has to be relatively cautious, particularly because we've had this acceleration and underlying trends, indebtedness being one of them, which we can't resolve. So there's two things. There's lots of supposition. Are we going to have inflation? Are we not? Are we, whatever. But there are two things we can hang on to. We can say almost empirically. Number one, valuations are relatively unattractive, and that implies low returns, which to my mind implies relative caution and also makes an equity-based income fund relatively attractive relative to fixed income, of course. And the second is we can't afford it. Interest rates can't go up very much. We can't afford it. Therefore, governments, if interest rates begin to climb substantially, will have to intervene. And what you have then is a very interesting situation. You have inflation rising, rates capped, and very negative real interest rates. And in that kind of environment, an instrument like an index-linked bond does very well. Well, I would say this, wouldn't I? But our portfolio, which is asset-light, businesses have demonstrated pricing power over time, and therefore has inflation-linked cash flows in the long term, could actually be a very good asset to hold in that scenario. So it's a confusing backdrop, but there are some things that we can say with some certainty.
Can I come in on this, Victoria? Because it's something that has occurred to me while James has been speaking, is that we're almost in a situation where we might end up with biflation, where you get inflation of those things that mankind really needs, essentials, the things that are need to have, and you're going to get a deflation, the vast amount of products and goods that have been still churning out of various manufacturers over the last year and a half or so, which induces a deflationary spiral in those things you really don't need, but were nice to have. So yeah, I think I've just invented a new word, but it seems to me you could have both at the same time. And similarly, you could have inflation in the United States, for example, but not in Europe and other parts. Given
okay, well, Chris, you are well known for your forecasting accuracy, so we will observe with curiosity this year what happens this year, and I mean, hopefully we can reconvene again at some point in the future, near future. And on this note, I would like to thank both of our guests, Chris Parry and James Harries, for such an interesting discussion and your views. And thank you for listening to Edison Group Investment Funds Forum. And I hope to see you all again at our future events. Thank you.